Good afternoon once again, everybody, and thank you for joining us in this superb session where we are going to be discussing intermarket analysis, navigating cross-asset trading. In the session today, we're going to be looking at how movements on a particular asset could play a major role in how some other assets move in the market. I have some example at the back of my mind already that we're going to be talking about. We're going to be exploring, the interest of the equities market and how they affect the currency market. We're also going to be talking about how even some currency pairs in the market affect some other assets, as the case may be, also in the market. We're going to be talking about correlations. We're going to be talking about, positive correlations, negative correlations, and a lot of factors that absolutely um, determines what happens to some of those assets in the market. The key thing for me is these relationships or this particular movement, as the case may be, is absolutely not 100% and definitely not something that we're going to be looking for potential, perfection from. Which means everything we're going to be discussing, we're not expecting to see perfection. We're not expecting to see that once we've learned it now, it means we can just go ahead and, take everything word for word without further confirmation or looking out for what the market is doing, at the time or for that particular day. But this is a very interesting topic. I tell you, it is one that I think you would really benefit from. And we're going to be starting nonetheless from, the king of the market, the dollar, right? We're going to be starting with the tree for the dollar and how some other assets in the market potentially affect some of these dollar pairs in the market and how you can create an interesting connection between them. So we're starting with the dollar. And let's create a three for the dollar. Please give me a minute. Let me just mute the notifications from my Telegram. I have no idea why it keeps pausing. Yes, please. So we're going to be creating a three for the dollar. We're going to express ourselves, see some, interesting correlations between the dollar and see what we can get with that. Starting from the dollar, what market potentially affects, the movement of the US dollar in the market. So we're going to create a tree, the US dollar, call sign USD. Now, for most of you understand that there's almost nothing that you're trading in the forex market that does not have anything to do with the US dollar. I tell you for a fact, like it's almost impossible. Even if you're talking about equities, there's still a factor that a dollar has to play on that. If you're talking about the currency market, definitely the majors are dollar related. Even the ones that are not dollar related also still get some of their, movements from how dollar or the major pairs moves in the market. And if you also look at for gold, it is also linked with the performance of the dollar. So absolutely, we're getting very interesting, movements from the dollar. And it is quite key that we are able to please give me a minute, guys. Let me just give me a minute. I need to take care of these notifications I keep getting. Just give me a minute. I think I've just muted them, right? Yes, please. I've muted everything. Oh, sorry. We're not going to get any pop-up anymore. Now, so we really cannot underplay the impact that the dollar is going to be having on the market. And that's why we're starting our discussion with the dollar. Now, think about it this way. The US dollar is the official currency of literally the strongest economy in the world, or even the biggest economy in the world, second sorry, China is the second on the list in terms of, the biggest by number, right? I think I can't remember the official figure, but yeah, the US dollar is the official currency of like a world power. It carries so much weight. And in this, linked with a lot of other factors and other things that affect the movement of this particular currency, it is one of the most dynamic currencies in the market. Why? Because sentiment plays a major role in how the dollar is going to move. At the same time, we also see that technicals also play a major role in the movement of the US dollar. That is history. But before the technicals, the fundamentals, the central bank aspect also play like major role in the movement of the US dollar in the market. But this is not even my problem right now. My problem right now is how does sentiment affect the dollar? And if it affects it, what are we supposed to be trading? How do we also see fundamentals affecting the dollar? Okay, if it even affects it, what are we supposed to be trading and what kind of impact do we get from this? Now, you see, from sentiment point of view, sentiment talks about the mood of the market. And in this case, if we're talking about the mood of the market is naturally either positive or negative, as the case may be. So it's either we're seeing a positive market mood or we're seeing a negative market mood, otherwise known as risk on, risk off, as the case may be. Now, if you're wondering what the word risk on is, let me just actually label that. If you're wondering what the word risk on is and what the word risk off is, you see, this particular relationship comes from thinking about, you know, humans as a person. You as a person, if peradventure you hear that a particular government parastatal is doing an empowerment somewhere, right? And they're sharing, let's say, I don't know, sewing machines, a lot of things that empower youth or something, and you're going there. But you know that such occasions, there would always be numerous number of people there, which means there's a risk of, stampedes, there's a risk of anything going wrong. In fact, there's a risk of losing your phones or something in the mix of all of this, because, empowerment like that, if it's not properly controlled, you've seen it before in the media, right? Where stampede comes from, where people are trying to share things to, the society and all of that. You know that risk is there. But maybe for one reason or the other, you feel like, well, I think if I'm able to get this particular thing, it empowers me to do a little bit more. I feel good right now. I think I can get in there, get what I need to get and go back, right? I mean, if nothing is going on with you wrongly, as the case may be, you would want to do it. You feel like the risk is not too much. It's something you can take. Risk on. Risk on means you know that there is risk, but you're willing to take it. In the market perspective, we take it down to talking about stocks. We understand that stocks or equities, as the case may be, are highly volatile slash risky, right? We know the stocks are volatile. We know the stock prices can go up and go down at any point in time. Any good news or bad news can always shift stock prices or equities prices in the market. But you also understand that the fact that this guy is this risky, it comes with higher returns. So which means it is compensated with higher returns. So if I'm going to do stocks, it must be that I understand that there is risk. I am willing to take the risk because it also provides higher returns, right? But if if trading stocks come at a time where, I just got a salary increase or I just got a double promotion at work, and my friend says, can you invest? Will you invest in the stock price of this company? I most likely will not say no. I'll say yes. Why? Because I'm seeing that my salary has just been doubled. I just gotten the good news. So I feel like I can take more risk. But if I'm in risk off, that is, maybe something is going wrong somewhere, I'm getting debated at work, I'm getting, hassled at work or something, I'm sick or something. If someone brings to me a proposal to trade stocks, I will most likely say no. Why? Because I don't think I'm in the right environment to want to do something that is highly risky, despite the fact that it comes with higher returns. So, which means our immediate environment, our mood at the time, determines if we're going to be interested in trading equities, trading stocks in the market, as the case may be. And in this particular regard, right, it means if market is positive, then absolutely we're looking to trade stocks. And that takes equity higher, higher equities. And if we have like negative market, well, instead of using trade stocks, yes, we still trade stocks anyway, but this time prices should be going down. So we're looking at lower equities. Now, what is the relationship of sentiment with the dollar or the relationship of equities with the dollar? You see, the thing is, the correlation between US equities and the US dollar is not positive. In fact, it is a negative relationship. It is, in fact, a negative relationship. Are you still with me? Why? You ask me why. You see, under normal circumstances, higher equities in the market is usually a sign of positivity. And positivity takes money into risk assets. And dollar, because of its nature as a safe haven, right? You know, dollar is the world reserve currency, as the case may be, right? If money goes into equities, people tend to demand for risk assets and throw away safe assets. And this might make me bring yields into the situation because naturally, there's what we call a capital movement between the US bonds market and even the equities market, which means naturally you would always see investors, when they lose confidence in the US economy, they take money away from the US bonds market, they take it into the stock market, and if they have confidence in the US economy and its stability, they take money from the stock market into the bonds market, which means in this case, we understand that bonds have like positive relationship, especially the yields part with US dollar, but stocks have negative relationship with the dollar. So which means if we see higher equities, if we see higher equities, we expect that to weaken the dollar, weak US dollar. Why? Because money left the US bonds market, which means investors lost confidence in the US economy as a whole, and they don't think it is worth investing in the bonds market, and they're taking their money straight into the equities market. But if we see lower equities means people are taking money away from the stock market, and there's only one other location they can take it to, which is the US bonds market, and that gives us a strong US dollar. And that is why we must also add that the same way, if we see higher US yields, it also gives us a strong US dollar. And if we have lower US yields, it gives us a weak US dollar. Now, in this regard, right? In this regard, you see, so now we understand that if the stories are coming from equities point of view, we should see negative impact on the dollar, especially if it is higher equities. If it is lower equities, we should see strength for the dollar. But from the yield side point of view or the bonds market point of view, if yields are higher, that's good for dollar. If yields are lower, that's bad for dollar. And now this means in terms of trading, right? In terms of trading, we can start from the yield side because you see, one of the most important things, especially with the bond market and with yields, is the relationship that we also have with Japanese yen. It is the reason why when we have higher US yields, it is always translating to upsides for USD JPY. So it's one of the major pairs that we always hang on to when it comes to trading bonds market and its impact on the dollar. But if we see yields lower, USD JPY is one of our favorite markets for itself. So one way or the other, one market that we really see a strong relationship with when it comes to the bonds market movement and the currency market, it is USD JPY. USD JPY. USD JPY. Also, another asset of sort that the market also potentially will look forward to, although this is not as strong as it used to be, because now there are other factors, that is being considered for movements in the market, right? Especially when it comes to, what we trade on a scale of preference, right? If we see higher US yields, strengthening the dollar, under normal circumstances, as the case would be, we should actually see some gold downsides on that note. And if we see lower US yields weakening the US dollar, we should actually see some higher gold prices. But that relationship or that connection might not be as strong as it used to be anymore. Why? Because recently we've seen a lot of factors being a major driver, for the movement of prices for gold right now. So much factors are being considered. Mostly the inverse relationship we have for gold and dollar is starting to show forth once again, but at the time it was completely eroded. There was a time where they would go in the same direction, but I think in recent light, it feels like that relationship seems to be back. I mean, we could just quickly take a look at what's going on between the USD index and the gold market right now. Let's just see if that inverse relationship is there right now. Let's see. At a point, it was so weak. At a point, that relationship was so weak, we could no longer trade the inverse relationship anymore. But let's see if that remains the case. Okay, I'm on USD index. We're going to explain it a little bit. But let's look at this week on the USD index, and that's from somewhere around here. USD index from 19th here. This was 19th. This is this week. The week started from 19th. And we've seen that USD index has pulled lower this particular week, downside, which means we should actually see some upsides for gold, right? Let's even check it from here. Let's also check it from here. Let's check this too. Let's make this one black. Let's make this one black. Okay. Yes. So let's go to gold now. Let's see if it is inverse. Let's see if gold, has been rising from 12th of May, or if it started rising from 20th of May. Let's check. Let's check. It won't hurt us. Let's check. Well, as you can see, like I said, we just started seeing that relationship normalize now, right? Because if you look at what we saw for gold and dollar, you notice that for 12th of May till 19th of May or thereabout, dollar was down heavy, But gold was not capitalizing on it. In fact, gold was up and down. Gold was down for the first few days, eventually recovered it for the next few days, which is what we call a range. So gold did not have that inverse relationship with the dollar within that period. Maybe you want to take a look at it one more time. See it here. This is USD index, clearly moving lower in that particular period. We should see inverse for gold upside, but rather gold prices was sitting in a box, up and down. But this week, dollar index has continued to go down more this week, and we're seeing that gold has actually pushed higher. Completely negative relationship, which is why I said, yes, there's that relationship. Also, with the bonds market, at some point, it was completely eroded. They were even moving almost the same way. The dollar will be going down. You also see gold going down. It was a point where you just wonder what was going on in the market. There was a point dollar was going up as well. Gold was also going up. But I feel like this week, 19th till 23rd of May, this today, looks like that relationship is getting repaired, and we're seeing dollar lose value, and we're also seeing the impact on what's it called on gold gaining value in the market. So maybe we might just have it on the list, right? Maybe that relationship is getting repaired. It used to be like that before, but at a point we saw that that relationship was completely eroded. So just maybe we might just be back. So under normal circumstances, we should see USJPY buy on higher yields. We should see USJPY sell, right? And that should actually also be accompanied with gold sell here, XAU USD. And it should be accompanied also with XAU USD buy here. At this point. At this point. I feel like that relationship is getting repaired. So just maybe. So in terms of the connection between the bonds market, especially yields, and how it affects some other assets in the market, on my scale of preference, you have USD JPY and then you have gold. Higher US yields should strengthen the dollar. That should pull USD JPY higher, probably pull gold lower, all things equal. And if we see lower yields in the US, that should weaken the dollar. That pulls USD JPY lower and also give us some interesting upsides, on gold. But when it comes to equities, right? When it comes to equities and how equities could potentially determine, the weakness or the strength of the dollar in terms of scale of preference of what we could be trading, as the case may be, we might have to look out for some of the, AUD USD upside, for example, on weak USD actually looks good. And we could also look out for on a weak US dollar, sorry, on a strong US dollar, then AUD USD downside also could look good when it comes to sentiment in terms of scale of preference for now. All right. And I'm not sure if I want to add NZD USD, but that should be the next. NZD USD also should be buy. If the market is buying equities, we should also be buying AED USD and NZD USD. If the market is selling equities, then we could also be looking for a sell on NZD USD and a sell on AUD USD. That's the first aspect. That's the first aspect. We're getting somewhere. I paused so that if you want to take a picture, you can take a picture or a screenshot because I'm going to clean this now and I want to talk about something else. Now, I also want to talk about how USD index could help you do a lot of things also in the market, especially when it comes to trading the dollar, US dollar, and the USD index. Now, you see, the USD index is a measure of the value of the US dollar relative to a basket of foreign currencies in the market. You see, it literally is the one that shows the performance of the dollar against some other assets or even currencies, in the market. So it means it's like, for me, one of the best measurement of how dollar is performing in the market at the time. Maybe not a true value, but at least a performance metric that you can actually accept. It means if I wanted to make some interesting comments about what is going on with the US dollar right now, I could just look at the USD index. I can start mentioning some story. I could talk about how, dollar had actually suffered a lot from this old tariff debacle, the back and forth from tariff implementation and all of that. I could talk about dollar suffering from Moody's downgrading the US bond market rating. I could talk about the fact that dollar also is getting weakened by the fact that President Trump continues to go back and forth on, Fed Chair Powell asking him to cut interest rate. I could give you multiple reasons as to why I think dollar is so weak and so bearish in the market. But I could also give you confirmation by pulling up the USD index, which shows the performance of the dollar broadly against a basket of other commodities in the market. And you can clearly see that I'm not wrong to say that dollar has actually lost so much value in recent times. Look at this. This is the performance of the dollar literally from the 12th of May till now. If you're even wondering, broad overview, let me just increase my time frame a little bit. And then you can see that over time, it's been so weak. So I've given you the story, but now I'm also giving you a chart to confirm the story. Downside, USD index down, clearly depicting the weakness of the dollar and the performance of the dollar in the market right now. Crazy bearish movement, as we can see. But how do we use the USD index to make decisions in the market? And how does it help us? Like I said, the USD index shows the performance of the dollar against a basket of other commodities or other assets in the market. And on this list, listen to this, of what the dollar is being pegged against to get the USD index, you have euro, and this is contributing 57.6% of the weighting. You have JPY next, contributing 13.6% of the rating. You have pounds also contributing 11.9% of that weighting. And then you have Canadian dollar, which is the card, also giving you about 9.1% of this particular weighting. And then you have the Swedish krona and then the Swiss franc contributing about 3.6 and 4.2% respectively. Now, this means if the dollar index is the performance of the dollar against a basket of other currencies on the market, euro, JPY, pounds, card, Swedish krona, and then the Swiss franc, and euro is contributing about 57.6% of the weighting, JPY 13.6%, pounds 11.9%, and card 9.1%. It means if I'm going to be trading the dollar index, or maybe not even trading the dollar index, if I was going to be making analysis on the dollar index, for example, maybe I'm going to be making some analysis talking about major stories in the market as the case may be, and also looking at technical levels. I mean, I could see this. I could see major levels of resistance. You saw that market retested this region, pulled lower from this particular point. You could also look at maybe somewhere around here. You say, oh, there's a level of support here also on USD index. Could we be seeing some potential switch up, maybe temporarily, maybe like retracements? Could prices just go back up a little bit? If prices will go back up a little bit, it means probably you're going to be looking at dollar strength in the market. What would I trade if I make any analysis, either for downside or for upside on the dollar index, for example? If I had, if I had dollar strength based on dollar index, for example, just as an example, based on dollar index, or let's make it clearer. If we make a projection for US dollar strength by analyzing the USD index, we could be trading the following. For example, based on this metric and this weighting, it means if I was going to be trading, the dollar based on an analysis done from the dollar index, for example, and I'm expecting USD to be strong, maybe I'm seeing a bounce off a good level of support, and I feel like if it bounces off this level, dollar should be strong, maybe even in the medium term or something, and I want to take advantage of that strength to come. Euro USD has to be the first on your list because it has the biggest weighting. Euro has the biggest weighting. And that means selling Euro USD, because if dollar will be strong, you should get downside for the euro, right? That means going to USD JPY and looking for a buy. That means going to pound USD and potentially looking for a sell. That means going to USD card, although maybe USD card negligible because USD card has a lot of other factors that plays a major role in how it moves, and 9.1 could also be negligible as the case may be. But you could also have it on the list, USD card, also buy, for example. And if we take a reverse of this, let me see if this copies. Yeah, it copies. Which means if we're going to be making a projection for US dollars weakness now, let's use weakness here. If we're going to make a projection based on weakness, right, we will trade the following. This changes. If dollar will be weak, this gives you a buy. If dollar will be weak, this gives you a sell. If pounds will be weak, so if dollar will be weak, this gives you a buy as well. And if this also will be weak, and this gives you a sell as well. So in terms of opposite, right, depending on what you're seeing at the time, if you're seeing potential weakness, then maybe, just maybe, you have Euro USD buy, you have USD JPY buy, sell, you have pounds USD buy and USD card sell on your scale of preference. On your scale of preference. And if it was projection for dollar strength, then absolutely Euro USD sell, USD JPY buy, pounds USD sell, and USD card buy, absolutely topping the list of what we could be looking out for on that particular list. I mean, this is some interesting things that we need to know about the market. We could analyze dollar index to trade the dollar and trading some interesting pairs. Absolutely important, crucial to your trading. Key, absolutely key. Absolutely key. And there's a reason why we've discussed majorly the dollar, because, I mean, dollar is the king of the market. Whatever information that we get for the dollar is as important as any other information you think you might get for any other currency, across the market. We have some other correlations, in the market, some other assets that you could also check and then see how it is moving on some other instruments in the market. For example, we do have, yes, we do have some other ones you could also think about, right? We have some close-knitted relationships in the market as well. I hope let me just put it one more time, just in case you're looking to take a picture, just in case. Yes, just in case you're looking to take a picture, all right. Just maybe, you can have a picture taken, and I'm going to clean this off, and then we can talk about something else. Okay, let's go on. All right. Now, you see, there are some other relationships that we can look to explore. And by the way, you could actually confirm the inverse relationship between the dollar index and some of these other markets that we've talked about: Euro USD, USD JPY, pounds USD, and what's it called? USD card. For example, if there's a very interesting downward movement on what's it called, USD index, it means if I was going to be looking at Euro USD, it should be higher. If I'm looking at USD JPY, it should be lower, right? If we can quickly confirm that before we just go on, just quickly see that Euro USD is absolutely higher from that period. You can see absolutely higher against the dollar because dollar is down. USD JPY, let's pull up USD JPY, absolutely lower also, for as long as we can remember. Yes, some moves happen, but you can clearly see, that downward picture aligning itself with the dollar index. You could look at pounds USD, and you could also see that beautiful move to the top, clearly showing that inverse relationship also with the dollar index in the market. And USD card, last but not the least, yes, that downside also quite evident. Yes, also in the market. So clearly, we could see that relationship from USD index spiraling into, the currency market, as the case may be. Another interesting relationship we could look to explore is the US oil and the Canadian dollar. Although, yes, there's that relationship, but maybe not as strong as it used to be in the year 2020, 2021, 2022, as the case may be. I think from around 2023, that relationship started breaking down day by day, day by day, day by day. But yeah, we have that relationship between CAD and the US oil in the market. But you see, the issue there is there might be some other factors in consideration that is causing that breaking down, right? And that might come from, central bank point of view. That might come from global geopolitics. That could come from even this old tariff debacle. That could also come from the place of tensions between multiple countries around the world, which is, well, we already mentioned that geopolitical tensions, also from OPEC point of view. So when you think about all of this, right, the whole environment we've had in recent times might have just broken down that particular relationship. But yes, we do have that US oil and the Canadian dollar relationship. Let's look at USD card. USD card is lower and clearly showing card strength against the dollar, right? And that should mean ordinarily, because they should be positive, if oil prices are up, then Canadian dollar also should gain strength. Why? Because Canada is a major producer of, oil in the world. I mean, we all know that. And if oil prices are also down, we expect to see the Canadian dollar should also lose value, which means if CAD can do this much against the dollar, you would naturally think, oh, okay, that means oil prices should be higher. But the problem there will be the movement of the Canadian dollar against the US dollar is not entirely down to, the Canadian dollar part alone. It's mostly down to dollar weakness on its own. So when we look at oil, we might be disappointed. I'm not saying we're going to be disappointed, but we might just be disappointed. Use oil right here, and you can see it's lower rather than being higher, which means oil prices are down, which means Canadian dollar should actually be lower against the US dollar. But the Canadian dollar is higher against the US dollar. So that's like a complete breakdown of that relationship. I mean, like I said, come year 2020, come year 2021, come year 2022, when you talk about oil and USD card, I mean, they are straightforward as you could call it. Higher US oil before, not now, would naturally translate to USD card downside. That will be lower USD card because dollar will lose value and Canadian dollar will gain strength. And when we have, or when we see lower US oil, then we would naturally be expecting higher USD card. Why? Because if oil prices are lower, Canadian economy is not making so much money, that reduces the value of the Canadian dollar, especially the fact that US and China, so US and Canada do so much business with oil, and that relationship is quite negative. So this gives you higher USD card. But right now, what we're seeing right now is USD card is down, US oil is also down. And I mean, like I explained, this is down to so many factors. This is down to geopolitics. This is down to dollar weakness on its own. This is down to the tariff debacle as well. This is down to OPEC as well, increasing outputs. This is down to a lot of factors. So yes, that relationship used to exist, but for now, I think that relationship is almost completely gone, or maybe 80% broken down already. And that might be a shame, and that might be disappointing nonetheless, in the market. But it used to be there. It used to be there. It absolutely used to be there. But right now, I think they are more inversely correlated than usual. And if we go by, listen to me, I'm saying this not as I'm not painting a picture, but it feels like now we have a completely broken down relationship between US oil and the USD card, as the case may be. And it just tells you something about trading relationships. Like I introduced this particular session, I did mention that what we're about to talk about today and this intermarket relationship is not something that you take hook and sinker. It's not something you write down somewhere and you say, this is all I'm going to be doing. They said, if this is going this way, this should go that way. So once I see that USD index is down, it just simply means Euro USD must be up. It means USD JPY must be down. It means Pound USD must be up. It means USD card must be down. Not necessarily. I mean, if we're lucky, maybe 8 out of 10 times it stays that way. But also you must understand that the risk is there that potentially some of those relationships could be broken down from time to time, maybe depending on what stories or what we're seeing in the market at the time. So please, what we are discussing today is not completely something that you take hook and sinker and say, they said this, so I'm just going to go ahead with this. Maybe not entirely, but it is definitely something to know, something to consider, something that you can say, okay, they said this should happen. Can I confirm if that is happening? And if you confirm that this relationship, as they've explained, is happening, absolutely key into it. If you see that, oh, it's not going the way they've mentioned it, it is a choice. You could completely avoid it, as the case may be as well. I mean, then we could also talk about some other relationship in the market, especially correlations, as the case may be. And that takes us to two guys, or not two guys, two groups, right? Two groups, the AUD and the NZD, and the euro and the pound. When you see these guys' charts, yes, you would absolutely find differences. But please remember, they are almost identical. They are almost identical. Like, I promise you, they are almost identical. In fact, if we run a correlation analysis on both of them, you'll probably be seeing a correlation of almost 95%. You'd probably be seeing a correlation of almost 95%. Let's just quickly take a look. Look at AUD USD, for example, and look at NZD USD. Looks so similar. Look at AUD JPY, for example, and look at NZD JPY. Look at it. You almost will not tell which is which. Look at, for example, pounds USD, and look at Euro USD. The only difference is that pounds USD is mostly in the air, but the movement of the chart, it looks the same. And that's one thing. You see, they are so close, and hence pairing them together is usually not the best bet. Rather, I mean, pairing them together, I mean, we don't try to, maybe not trading AED and NZD is probably not the best bet. Nah, maybe not the best bet, or maybe not the best bet to have together. Trading Euro pounds might also not be the best bet to have together. Right. Rather, you might want to consider them with some other assets in the market. For example, if for any reason, let's treat these guys on this side, antipodians, the antipodians, that's the name, the antipodians. Now, these guys, you see, if there's something you can call the most, oh my God, I'm trying to avoid a blunder, but if there's, we have risk currencies and we have safe currencies, past sentiment. If there's something you can call like the most risky currencies, it is the antipodians, right? They're highly risky. They have this nature as a safe, as an high beta to be, really moving from time to time. Good news, bad news, they're up and moving. Right. And for that reason, usually you could always bet on AED JPY. Oh, yeah, that takes me to another group. Let's make a triangle then. JPY and CHF. Yes, we're getting somewhere. Yeah, yes, that's another group. Oh, yeah. I just remembered. Yeah. Let's have a triangle. Let's have a triangle. Oh, interesting. We also naturally will not put JPY and CHF together. So which means CHF JPY might not be the best bet in terms of trading, but very, very interesting pair from fundamental point of view, from technical point of view, but from this intermarket relationship and correlations, maybe not the best pairs to have together. Now, AD, NZD as antipodians, right? Highly risky and whatnot. So let me just change my approach here. Let's make it a little bit more interesting. Antipodians. This one's safe havens, very safe, not highly risky, very, very strong economies as the case may be. These guys, not even just strong economies, I mean, safe economies as the case may be. So they're safe havens by nature. For euro and pounds, we really don't have a name for euro and pounds. In fact, the closest I saw online is European bloc. And I don't think it's not really a catchy name or something. It's not really a generally accepted name. Let's put it that way, right? But euro pounds, just usually called European currencies. Some people say the European bloc or something, but it's not catchy. But for AED, NZD, antipodians, also known as I betas, let me just put a slash there, also known as I betas. Yeah. Yeah. For euro pounds, the relationship came all the way from when the euro was first the benchmark for commodities around the world before it was changed back to the US dollar. And when the Bank of England made the mistake at that time to peg the value of the pounds to the euro, that period, and if you read the story of Black Thursday and the story of the man who broke the Bank of England, you understand what happened, right? It's a very interesting story. So if you're interested in it, you can read it. How euro and pound became so close knitted. I can't remember the year, but it was that time where euro was first the major um, currency that we price goods and services, around the world. And then the Bank of England pegged the value of the pounds to the euro at the time, right? It was so interesting at that period. You can read the story. I don't really want to go into that right now, but yeah, for euro and pounds, no common name really. They just said European bloc or something. I don't think I want to go on with that. Now you see, the name antipodians, the name I betas, the name safe havens came from sentiment. And you see, the beauty of this is by nature, the safe havens and the I betas are not friends. In what sense? The same way water and fire are not friends. It's the same way the safe havens and the antipodians are not friends. Why? Because I betas, highly risky, are only getting love from the market when things are going so well, where everywhere is positive, nothing bad is happening. Oh, then they get so much love from the market. The safe havens don't get any love at the time. Why? Because if everything is going so well, I don't need an umbrella. If rain is not falling, I don't need an umbrella. Right? So it's the same way. If things are going so well, I go with high betas. I go with something risky, make so much money. I don't need safety. If things are not going so well, then I need safety and I don't need highly risky assets. So by nature, they are not made to be friends. By default also, they're not made to be friends. So in terms of sentiment and in terms of trading positivity, negativity in the market, usually, like I would always say, if one of the biggest concepts in the market by default is that we should always look to trade strong currencies against weak currencies, or we should always look to trade polar opposite currencies against one another, that is white against black, black against white, white against red, red against white, as the case may be, then it means these two sides with completely opposite factors are better when paired against one another because by nature, they are never made to be friends. Never. At no point in time am I expecting AED and NZD to become safe havens. It won't happen. At no point in time am I expecting the JPY and CHF to become high betas. I don't think it will ever happen. I mean, well, nothing is impossible for this market, but I don't think that is something I'm going to consider happening. For example, within the current market environment, there are some currencies that did change shape. We saw dollar change shape. Well, maybe not change shape, but dollar used to be also a safe haven, although a dynamic currency that could also act as an IBETA sometimes, but it did completely change shape. We saw that euro pounds also changed shape. We saw euro pounds, instead of getting strength from positivity, they were weakening on positivity and they were strengthening on negativity. Right. So, but for AED and NZD, they never changed shape. For JPY and CHF, they never changed shape. Why? Because that's their nature by default. So it means in terms of trading, positivity, negativity, as the case may be in the market, they absolutely, absolutely, are the best bet to put together. So what we're going to do is we're going to create like something here, right? We're going to remove this. And we're going to write positive market here, positive market. And we're going to go negative market here. Now for positive market, absolutely no debate. AED for a buy is a very big bet for a trade. That goes with AED as well. A good, interesting, market for a buy. I mean, naturally, I would proceed to write NZD-JPY after AUD-JPY, but NZD sometimes, could have well, some quotation marks around it, problems at the time. So yeah, it might be just the third option, and then you have NZD-CHF as the fourth option as well. All of them for a buy, and that completely, negates itself in a negative market. We don't need to think twice. Let me just copy this one and just reverse it. Copy and then reverse. All right, and we just change all of this to sell. We change this as well to sell. We change this as well to sell. And we change this as well to sell. So by default, these guys would never like themselves. As long as the market goes positive or the market goes negative, there's always going to be a switch, right? Remember, I told you capital market mobility between stocks and bonds when we first introduced sentiment, right? There'll never be a time where they would be friends. It's always going to be give and take, as the case may be. For the euro and the pound, you see, yes, closely knitted, as the case may be, and the same way they move against a particular asset is probably the same way the other one will move. What that means is if for a reason you're going to be buying pounds USD, there's almost no reason to leave out euro USD buy, except if there's a fundamental discourse at the time. If for any reason you're going to be buying pounds JPY, there's almost no reason to not add euro JPY to that list, except, of course, there's a different fundamental discourse or a different factor affecting particularly euro at the time. But usually, euro USD, pounds USD is almost the same. So if you have a reason for buying euro USD, you almost immediately have a reason for buying pounds USD. If for any reason you have a reason to buy pounds JPY, you almost immediately have a reason to buy euro JPY. If for a reason you have a reason to buy pounds AUD, you almost have a reason to buy euro AUD. They tend to move so similarly against every other assets in the market. Put them side by side. If you can justify one, you almost have a justification for the other one. So which means this is the reason why I'm not going to write a specific pair, but if for any reason, from any, maybe fundamental reasons or from, let's say, from technical analysis that you're doing, or maybe you even have like an economic data releases or something that you're trading for a particular side, you could immediately consider its friend against the same currency. If I'm looking for Euro USD upside, I'm going to look at pounds USD to see if there's an upside opportunity on that guy as well. If I'm seeing Euro USD downside, I'm going to look at pounds USD to also see if there is opportunity for downside on it as well. Closely knitted relationship. Intermarket relationship. I mean, we've talked about quite a lot, especially from dollar point of view, from stocks down to bonds, to dollar index. And then we've talked about, the US oil and card. And now we're talking about AUD, NZD as a pair together, JPY, CHF together by nature, right? And I think this is absolutely important. AUD, NZD can absolutely be traded. Maybe fundamental differences or something, or technical differences or something. CHF, JPY, in fact, loved by a lot of people in the market. Euro pounds also loved by a lot of people in the market. But because of their nature to be similar, they might not be of the best bet to put together, except you have a fundamental reason that is separating them at the time. Intermarket relationship is so important to note because, imagine you just on your seat somewhere and you see something and then your brain clicks that if this is happening, then this should be happening here, okay? If that is happening there, then this should also be happening at this particular point. That's the idea. That's the idea. That's the idea. That's the idea. Well, someone just caught my attention to a potential news from Trump. Ooh, why is there a massive reaction on the board? Let's see. Ooh, I feel like maybe that's due to Trump's. Someone just mentioned that Trump made some comments about taxing the euro area. I don't know if that's fresh. You can quickly check though. Oh, okay. Trump recommends a 50% tariffs on EU starting on June 1. All right, you're right. You're right. There's absolutely a reason why we're seeing jump, across board right now. Yes, yes, yes. Trump tariff story seems to be back. I think pound USD reaction is not as much as that of the euro, but absolutely getting the heat as well. Well, because he cannot shake it off. If euro is reacting, pounds will not be able to shake it off. It's bigger on euro USD because it is EU directly, but pounds also we have to follow suit. It has no choice but to follow suit. USDPY should be jumping. Sorry, lower negative market condition, lower as well on what's it called tariff headline. AED USD lower as well, absolutely negative market. So AED USD should be lower, in the session as well. I mean that's just a lot right now. But yes, that's one way you could just be sitting on your hands. You get the news, it's tariff. Is it good? Is it bad? Oh, it is bad. If it is bad, then it's a negative market. If there's a negative market, okay, AUD JPY, AUD CHF, are they moving according to what they're supposed to be doing? We're looking at AUD JPY right now. And yes, absolutely crashing, crashing, crashing. Crashing 104 pips already. AED CHF as well should be following suit as well. Also crashing lower, almost 52 pips already. AED CHF also responding. Let's see, NZD-JPY, is it responding as well? NZD-JPY, absolutely as well. Downside also on NZD-JPY, NZD-CHF as well. Should be lower in the session. NZD-CHF, NZCHF. Yeah, NZCHF also smashed lower right now. I mean, look at that. Just look at that. Just look at that. And that's why it is always important to understand how, intermarket relationship and all of these things affects, the market. So that if you're getting in on one, you don't miss the opportunity on the other one. If you're getting in on this one, you should immediately consider the other one. If I'm selling AED JPY, I mean, NZD JPY should also be on my list. If I'm buying Euro USD, pounds USD should be on my list. If I'm selling Euro USD, I should be selling pounds USD as well. Right. So they have that, close knitted relationship like that. But ladies and gentlemen, this is what I have for you today from this particular topic. Really interesting topic. We're going to have recording up on YouTube to come. Absolutely, absolutely. For those who said they came in late, you're going to have recording on the session to come on the HFM YouTube page. But we've gone a little bit above time. We should close one. It's currently 1:12. If you have questions, please put them in the chat box right now about what we just discussed. Please put your questions, sorry, in the Q&A right now, and we're going to attend to them right now in this session. Please send in questions if you have questions. We'll pick a few and we'll close this because we don't have so much time on our hands. Please send in questions, send in questions. Let's see. As Isam says, this guy has come again. Can they block his account? They can't block his account. How is this current tariff going to affect gold? Gold is a safe haven, and that's a positive response. All right. You can already see positive response on gold. By natural default, gold should be higher, and that's why we can see a jump. I don't know if it can sustain this, right? Because also we saw that in the beginning phase of this whole tariff thing, gold jumped on tariff implementations, on negative conditions as a safe haven, but also at the time, we also saw that gold was also losing value on tariff implementation as well. So, but I think the upside should outweigh the downside, right? I think by natural default, because it's fresh, we should see some good upsides, but also be concerned because gold is getting into some territories, resistance territories where you might be looking out for, it might start struggling for a while. This is absolutely, not a place where you might just jump beyond. But if you're asking what a negative news should do for gold, a negative news naturally should help gold push higher. The fact that it is tariff might be just the only, question mark there. Because we saw that there was a time where even when the old tariff thing was negative, we saw that gold was going down, and it was blamed on the fact that gold was, a precious metal, and precious metal value should go down on tariffs, right? So I don't want to paint a straight line picture. I want you to paint a picture of what we've seen in recent times. By default, it should be higher, all right, but it's running into a resistance, and it could potentially give you some retracement also. We already explained that equities like US 100, US 30, US 500, they have inverse relationship with the dollar. That was the first thing we started with. If they are higher, good, dollar should be down. If they are lower, dollar should be up, and that's vice versa too, which means if dollar should gain value, they should be lower. If dollar should lose value, they should be higher. For example, with this old tariff thing, it wouldn't be surprising to see that equities are also on their way, pumping lower as well. I mean, already you can already see it. Absolutely, it's a negative news, and you can already see US 500 pumping lower. Yeah, that's not even a debate. If there's a negative news that would help, safe haven demand, a risky asset or a risk asset or a risk equity like US 500, US 100 should dive lower. And this is US 500. This is US 100 right here, absolutely lower, and this is US 30 following suit. So if you're asking relationship with US 30 and dollar, it's inverse right now. Not right now, naturally inverse. If dollar should be going up, they will be going down. Dollar is going down, they will be going up. That's for limited Charles. What's the relationship between US dollar and commodity currencies like AED? They should not go in the same direction as well, mostly inverse as well. AED USD, also SAD USD, USD card, also, they are not expected to go in the same direction, usually inverse, because if stocks are going down, it weakens other risk assets like AED, NZD, and CAD. Commodity currencies are also risk assets, so which means against the dollar, if this one is going down, they would be going down also against the dollar. If this one is going up, they would also be going up against the dollar. That's Mr. Roland. How does the US CPI affect the Forex market? Well, that's not an intermarket analysis question. That's just like a data question, but it's usually a positive response or a positive relationship. Higher inflation is good for US dollar. Lower inflation is bad for US dollar. So which means if higher inflation comes, which is good for dollar, then you should see downside for equities. US 500, US 30, US 100 should be lower. Downside for AUD, downside for NZD, downside for CAD as well as risk asset. They should also be lower. Then it means USD index should be higher, and then vice versa, all of those information. Yeah, it jumped. Yes, gold jumped higher, but still at the rate. That resistance will hold price for a while, Mr. David. Chukweku David, yes, absolutely. That resistance will try to hold price for a while. It should eventually give way. And the fact that it is also Friday might also be a concern. So I don't know if it's going to give way now, but eventually should. Between USD JPY and pounds JPY, which one is the best? I don't think I'm in the right position as a trader to tell you which one is the best. I can say from my own point of view, I prefer USD JPY more to pounds JPY. USD JPY has, no problems with fundamentals, no problem with geopolitics, no problem with what's happening at the time. Usually big response in response to USD index. So in terms of complexity of decision making, USD JPY is quite easier than pounds JPY. That's my own perspective. I cannot say for the market. Is it necessary for traders to build their trading on correlations? Absolutely not. But is it also crucial that you have information about it and you know it so that the time is going to serve you, it can serve you well? Then absolutely yes. So I wouldn't say build all your trading around it, but I would also say disregard and not know it. It's not possible. You should know it. You should know how one market affects another market and another market. Absolutely, you should know it. It might not be intact again at the time, but it is absolutely something that should be in your information arsenal, right? You're not building your training around it, but you must have it in your information arsenal. I think that exhausts what I have as questions in the Q&A. It was an absolutely amazing session again today. Thank you, ladies and gentlemen, for always tuning in for our webinars. My name is Emmanuel Olalikon Akinola, Market Analyst at HFM Nigeria. We'll see you again sometime soon. Please enjoy the rest of your afternoon and bye for now.